Hello, this is Mike Swanson. I run the website WallStreetWindow.com. And today I got a very special guest with me. I'm speaking with Jordan Roy-Byrne, who runs the website TheDailyGold.com. How you doing today, Jordan?
Hey, Mike, I'm great. Thanks so much for having me on.
Well, I really want to talk with you because to me, maybe a transition year in these markets. Um, I see some danger signs in the stock market. Did a video talking about that, but I also personally I own a lot of gold and silver in my accounts, the metals ETFs. Uh, but that said, the mining stocks haven't been trading that well, and you kind of got an article that sums it all up. Gold stocks are cheap and hated. What do you think's going on with it?
Well, Mike, I think that fundamentally, or at least technically, if we look at gold, gold had that peak in the summer of 2020, August 2020, and since then, yeah, gold's corrected a little bit. It's been consolidating. You could say really bullishly, but that's been over 3 years. I mean, we're in February now, so I think it could be exactly 3.5 years since that peak in August of 2020. So 3.5 years. I know the gold price is about where it was at that peak. So 3.5 years of no progress. And then if you look at the silver price, I mean, the silver price peaked at, I don't know, 28, 29. It's down at, around 23. So you basically have you have 3.5 years where the silver price is down 20%. The gold price is basically flat. And you can look at that and say, well, that's not that bad. Gold's flat, silver's down a little bit, gold's consolidating bullishly. But the problem is in that 3.5 years, the cost of production, the cost of mining because of inflation has gone up significantly. It's not just up like 15 or 18%. I mean, for most companies, the production costs are up 35 to 40% in the last 3.5 years. And so for mining companies, well, I mean, production costs, that refers to mining companies, but this is a huge problem, especially when the top line, the top line, again, the gold price is the same as it was, the silver price is down. So it's really, really tough for these companies. Again, you go back 3.5 or 4 years ago, gold prices at 2000. Let's say you had a mine where the all-in cost was 1,000. Well, that same mine now is, the cost could be 1,400 to produce. So margins for mining companies are down significantly in the last 3.5 years. And, what I've started to notice, I think in the last year or year and a half or so, is that the valuations on miners are going down at the same time. So the market is getting, more just distraught, more pessimistic about gold and silver mining companies, as a result of, first margins are being compressed, and then it just continued. Gold has been unable to break above 2,100. Silver price is down again 20% from that 2020 peak. So you look at those factors, and then again, more recently in the last 6 to 12 months or 18 months, valuations are really starting to come down. And in addition to that, Mike, as I showed in the article, I mean, you can see the screenshots of some of the comments on one of my YouTube videos talking about gold stocks. People are very frustrated. They're very upset, and so everybody hates gold stocks. Now that doesn't mean today or tomorrow every gold stock is a buy, but it does mean that I think at some point this year we're setting up for a real significant bottom and a real significant buying opportunity potentially over the coming months.
Well, I want to throw something out at people, and last year, um, I bought. I just sold these today, but I want to draw similarity to gold stocks because I bought shipping stocks last year in July, and at the time they were paying like huge dividends over 10%, and the valuations were cheap, and most of the shipping stocks, I mean, they were trading pretty poorly, and now they've doubled, or some of them gone up more, even more than that, and no one liked them then. the point I'm trying to make is that, yeah, here's Newmont is at a new 52-week low. And it's awful what's happening in Newmont, even though it's paying like a 4.5% dividend. But at some point, like the shipping stocks went up, these stocks got to go up too. What do you think could be a catalyst to get them to start to go up?
Well, there's a couple things. First, if we're looking at technicals, gold breaking above 2100. Now, gold breaking above 2100 will be really significant. One issue is gold is underperforming the S&P 500, the stock market, pretty badly right now, and so that's really holding gold back in the near term sense, but also in the very big picture sense. So, in a much larger sense, precious metals are not in a secular bull market. They will be in a secular bull market when we see the stock market crack. And for me, if you look at the S&P and you're just looking at 20, 30, or 50 or 100 years, the 40-month moving average for me is a really good demarcation line between secular bulls and secular bears. And so the market is not too far above that line. So even if we have a 25 or 30% bear market in the next year or two, that to me would lose that 40-month moving average support. So in the very big picture, that's really going to be the trigger
And
for
40, I don't, that's like 800 days. Is that right? 40 months?
Yeah, if you're looking at a weekly, I think you could put the 170 week moving average.
Okay.
That's a pretty good line. So if you look at a weekly chart, um, I mean it's really
Yeah,
nice historically.
42.17, 42.
Yeah, I mean and if you don't have to, but if you just look historically, going back 60 or 70 years, I mean it really does a nice job of showing the secular bull and secular bear. So in the very big picture, when the stock market cracks and after the next downturn, even if it's only a little one or a small one, that's really going to kickstart the new secular bull in precious metals. So that's one thing. Now, on a more near-term, short-term basis, it's probably rate cuts. I know you talked about that. So the majority of the time, rate cuts tend to be very bullish for gold and precious metals. So if you tell me we're going to have a rate cut at some point in the next 3 or 4 months, then I'll tell you gold is probably going to break out in the next 2 or 3 months and move above 2100. So
Well,
that's one. So that's one catalyst. The larger catalyst beyond that is you have a downturn, you have an economic recession, even if it's a small one, and you get a bear market in the S&P, that is going to be the trigger for gold, not just gold going to 3,000, but gold going to 4, 5, 6, 7,000. So I'm extremely confident this is going to happen in the next 2, 3, 4 years, Mike. We're getting really close to that secular changing point. So in the big picture sense, that's the key. But if we're just focusing on the next 3 to 6 months, the rate cuts, that's the catalyst to look for. Because and I would say, if the Fed starts to sniff more economic weakness, then they're going to cut rates. But we've had some strong economic numbers recently. I don't think that's sustainable. But if the economy chugs along and the data doesn't get worse, and the rate cuts get pushed back out further in the year, I mean that could be a negative for precious metals, or at least prevent gold from breaking out until later in the year. So it's important to look at both sides in that respect.
well, one thing, it's kind of funny, like with gold itself, I own gold, as I said, and I don't feel worried about it falling very much, because on a correction here, because last year the Federal Reserve raised rates all year and gold didn't fall. It finished the year up. It tested 1850 about twice, but it didn't, have some big decline. And we've been in the gold market one way or the other now, both of us, for a long time. We've seen gold have big declines and the mining stocks completely crash. So when I see interest rates go up and gold be in a trading range, that makes me feel comfortable to hold it and buy it, because the day will come when there are interest rate cuts or a recession and so forth, as you're saying, and gold would then take off. So it may not be outperforming the S&P 500, but I feel safer owning it than I do the S&P 500, because the S&P 500, I think, does have more potential downside here when it has a bear market at some point. And gold, I don't really think has that downside.
Yeah, I completely agree. And that's a good point about gold holding up really well in the face of rate cuts. Like if you look at gold, usually, I mean, most of its history, it performs to the inverse of real interest rates. And as the Fed was hiking, real interest rates were really surging higher. I mean, there's I don't remember exactly when last year, but there was some point last year where real interest rates were at, I don't know, +2 or +3%, depending on if you're looking, maybe it's the real 10-year yield or the real 5-year yield. But you know, given where real interest rates were going, I mean, if we're just thinking about this 3 or 4 years ago, we're saying, okay, the Fed's going to hike. They're going to hike to 5.5%. Inflation's going to come down from 8% to the low threes. Given what we know about history, and in the same vein, real interest rates are going to go up from -2 or whatever they were to +2 or +3%. Um, that's the recipe for gold really getting pounded, like in really hammered. Like if you told me that, I would have said, okay, gold is probably going down to 1,500. Maybe it's going to go down a little more than that. But Mike, as you said, look at what has happened over the last 3 or 4 years. I mean, we did have this dip below 1,700 for a little while, but gold has held up really, really well. It's in this super bullish consolidation. And again, even at the end of the Fed's rate hike cycle in the first half of last year, whenever they stopped, gold was it was really close to breaking out. It was back at 2,000, and it's back at 2,000 now. So gold holding up. I mean, it during that entire period, it's held up really, really well. And I mean, the stock market, gold's really badly underperforming the stock market, but the stock market just broke to another new all-time high recently after a 2-year correction. So that's also not good for gold. So despite all these things, the gold price has held up really, really well. And it's sitting there, less than 2% from making a really significant breakout. And the other thing, Mike, is, gold has held up really well, thanks to central bank buying. But if you look at investment demand, like it's been really, really low. So people are not, they're not buying the gold ETFs. And despite that, gold has held up really, really well. So all the investment capital in recent years has been going into the stock market. And now gold has been helped as some of that capital has come out of bonds. So that's helped gold stabilize here. But eventually the bond bear market will hit the stock market and drag the stock market into a bear market. And that's also part of why I think gold is holding up, because some of that money coming out of bonds is worried about inflation and going into gold. So, but long story short, Mike, gold has dealt with a lot of negative factors in recent months and recent years. And yet, if you look at the chart, it's in this super bullish consolidation, and it's right there, 1% off its high.
Well, I'm going to link to your article in the description of the video so people can read the whole thing. But this jumps out at me, and that is just this sentence: mining margins will expand with valuations after gold clears 2,100 an ounce. So you pointed out early in our discussion that it's the rising costs of inflation that have hurt the bottom line of mining companies that have to do production, that produce gold. And with once, but if gold goes up in price, the mining profits, the revenue expands, the margins will expand, and so it does a good, it's a good clear explanation for why this 2100 is so important. So I'm going to link to that in the video. But what else on your website do you provide for people?
I provide just lots of videos. I mean, I post interviews like this, video analysis. I mean, some interviews that I do with companies, and articles that I write. So just all my free content is there on the website. So I publish a lot of free content so people can check that out and get informed as best they can about precious metals, because we're getting much closer to the start of a new secular bull market. I mean, this is something that is going to run well into the next decade. This is like a 10 or 15 year secular bull market that's coming. Again, it hasn't started yet, but we're getting really, really close. And one other thing, Mike, if you look technically, if you look at how gold has performed over the last 7-8 years or so, it's very similar to how the S&P in the U.S. stocks performed from like 1974 to 1982. The stock market did not, it's secular bull, the 82 to 2000 secular bull, it didn't begin until 82. But if you look at the chart, like you could say, oh, well, it really bottomed in 74. It made a higher low here. But if you're looking at its performance in real terms, its real acceleration, its adoption by the masses, that did not happen until 1982. And so the gold is basically set up very similar to the stock market when the stock market was in 1980 or 81 or 82. Like there's a lot of similarities. And so again, we're not there yet, but we're closing in on the beginning of a new secular bull market for gold and precious metals. And so one of those things is gold breaking above 2100, and then the other thing is gold really having to outperform the S&P 500. So you need the S&P 500 to crack at some point for that change to take place. And so when that happens, that's going to set up this 10 or 15 year new secular bull market that's coming for precious metals.
It's been a long time since we talked, and I remember talking with you about this chart, which is the gold divided by SPY ratio. And in 22, it popped up, and it really, if this measures how gold is performing relative to the S&P 500, it's been going down since 2011 and trading weak the past couple months. But if it breaks out this ratio, then it's outperforming the S&P 500. And when we last talked, you're saying this is one of the most significant things you're looking for.
Yes, because you cannot have a real secular bull market in precious metals without gold outperforming the stock market. And you can even go back. I mean, look at the summer of 2018 to early 2020. I mean, there was that 2-year period where you kind of had a cyclical bull. I mean, you had the COVID crash in there, but I think gold went from like 1150 up to 2000. I mean, it was close to like 80% move. And you can see during that period, gold outperformed the stock market. I mean, it was in the context of this very large downtrend that we're talking about, this historical downtrend. But you can see it there. You can look at the low in 2018 and then look at that peak in the spring of 2020. So gold doesn't go up 80% without that outperformance. And so yeah, again, it comes down to the two things. First, gold has got to break 2100. And if it does that, it can have another, $200, $300 worth of upside. But for gold to get well beyond 2400, it has to outperform the stock market. And you need to see cracks in the stock market and real cracks in the economy. And because that gets all the people who've been putting, generalists who've been putting capital in the stock market and all these stocks who don't care about gold, when they start, the market cracks, they start looking at other sectors, and then they just start putting some of their money into gold and gold stocks. That's how you get a new secular bull market. And Mike, I know that you saw this happen in the early 2000s when
Oh
you
yeah.
got into precious metals.
Oh yeah, and you can see that on this chart of the ratio, how it went up from on this chart 2005 through 2008 up to 2011 and so forth. And it was it was incredible, incredible run. And silver was incredible. Silver went up like nuts in 2011. So, but your article. About gold stocks being hated and the valuations are cheap. It's kind of funny because it's the opposite with the stock market. The stock market's highly valued, and everyone is fascinated with the concepts surrounding it, like AI and so forth. I guess we need to tell people there's AI with mining stocks.
Yeah, I mean, maybe if some of them start mentioning AI, maybe that could be a contrary indicator. I think some junior mining companies in 1999 and 2000, they started pivoting to tech.
Well, wasn't some small junior that had something to do with GameStop or something too? When that GameStop meme was happening?
Oh yeah, I don't I think it might have been GameStop where they bought this project in Nevada, this huge low grade
That's
project.
what it was. They bought a junior. They bought a silver
Yeah,
company.
yeah.
Yeah, yeah. And for a few weeks, the GameStop players were interested in silver.
Yeah, the silver squeeze,
Yeah. But
which
that's not.
marked the recent cyclical top
Yeah,
in
yeah.
silver.
And I remember talking about it with you, and you weren't a believer in the silver squeeze back then. I mean, it's not what creates bull markets.
Right.
Well, thanks for taking the time to talk to me. And we'll have to do more frequent interviews, especially now as we're approaching interest rate cuts in a couple months, and it should drive gold above that 2100 level.
Absolutely, Mike. Thanks for having me on.